The Nuburu Inc. BRU stock closed on Friday, October 17, 2025 at $0.34 with a slight intraday gain of plus 0.85% or roughly $0.0029 and a subsequent after-hours dip of minus 1.66% to $0.3343. The market is now closed, so this $0.34 closing price is the last actionable figure we have. While the daily movement was negligible, to focus on that small uptick or after-hours blip is to miss the far more compelling story unfolding within this micro-cap laser company. The expectation, especially from a quick glance at the stock chart, is a narrative of a struggling penny stock that's simply bouncing around its 52-week low of $0.12. But the reality is that the company is undergoing a radical, sudden, and highly aggressive corporate transformation, a strategic pivot away from its original core business that most retail investors have yet to fully digest, making it one of the most intriguing and volatile high-risk situations on the entire exchange right now. This isn't just a laser company anymore. It's attempting to transform into a defense tech and operational resilience software provider through rapid-fire acquisitions. That's the unexpected twist that should immediately raise your eyebrows, regardless whether you're a self-investing individual using a platform like Robinhood for quick trades or a more seasoned account holder with Fidelity, utilizing Schwab Intelligent Portfolios for your investment strategy. The common understanding, the general belief about Nuburu, is that it's a pure-play industrial blue laser manufacturer that simply hasn't found its footing. This perception is entirely fair when you look at the fundamental financial reality. Annual revenue collapsed from $2.09 million in 2023 to just $152,127 in 2024, reflecting significant difficulties in gaining commercial traction for its core technology. Gross profit has been deeply negative, and the balance sheet is stressed. The stock has been highly susceptible to dilution, especially with a recent public offering that aimed to raise capital. This difficult backdrop is precisely why the stock, despite a recent flash surge from its September lows, is still trading in the low dollar per share range. Investors are worried about further dilution and the very real risk of delisting from the NYSEAMERICAN, a risk highlighted by a recent warning letter from the exchange itself for a technical non-compliance issue regarding timely disclosure. That's the reality falls short of expectation view. However, the contrarian, deeper take is that this stock is now an acquisition play, not a laser play. The recent volatility isn't random. It's fueled by a flurry of high-stakes corporate announcements signaling an immediate shift into the defense and security hub space. This is a dramatic, almost last-ditch effort to create value by leveraging the company's public listing status to purchase established or at least promising assets in the defense tech and software-as-a-service sectors, most notably with the pending acquisition of an Italian operational resilience software firm, Orbit SRL, and an agreement to evaluate another potential defense acquisition. This pivot is the true current market driver, creating tension between the old, struggling fundamentals and the promise of new, high-growth, high-margin business models. The stock's jump in the early part of October, a massive surge of over 140% in the prior month, was largely a reaction to these aggressive acquisition and corporate restructuring announcements, which is a powerful signal that the market is willing to bet on the new Nuburu, even with its past baggage. The question is, can this highly leveraged strategic shift be executed effectively? The recent stock movement perfectly illustrates this tension. The stock's dramatic volatility is not an anomaly, but a feature of its current transformation. Look at the daily swings. a recent high in early October near the $0.98 mark, rapidly followed by a severe pullback toward the $0.30 range. This massive fluctuation, moving between $0.30 and $0.41 just in the past week before settling near $0.34, is typical of a microcap undergoing a transformation fueled by dilutive financing. The recent public offering that raised $12 million in gross proceeds while providing the necessary capital for the acquisitions like Orbit simultaneously flooded the market with new shares, naturally putting downward pressure on the stock price. High-volume days, which have become common for BRU, are a mix of retail traders attempting to catch a parabolic spike, a common behavior in stocks this cheap, and institutional activity related to the financing and the hedging of those new shares. The stock is currently caught in a tug-of-war. On one side, traders betting on the acquisition news to provide another momentum burst. On the other, the steady downward grind from dilution and the macroeconomic pressures that constantly challenge small, unprofitable businesses. When we look at Nvidia stock or Apple stock, their movements are tied to massive, well-established sector momentum. Nuburu's movements are tied almost entirely to corporate press releases regarding its strategic pivot and its compliance status with the NYSE. The NYSE compliance issue, though seemingly resolved as a technical communication timing issue, is a huge factor for institutional credibility and why many sophisticated individual brokerage accounts or intelligent portfolio services, like those from Fidelity Investments, might steer clear. For any investor, particularly those who invest online via platforms like SoFi Invest or Interactive Brokers, the sheer volume, which recently hit almost 100 million shares on an average day, shows heightened speculative interest, an environment often characterized by extreme swings and technical trading patterns. Technical analysis currently shows a mixed bag, a short-term sell signal but a long-term buy signal from the moving averages, indicating that the recent parabolic move still holds some underlying bullish structure, provided the stock holds above the long-term support level, which currently sits around the low $0.200. Now, let's establish what Nuburu actually was before this aggressive pivot, because its foundational technology is still part of the equation, even if it's currently being sidelined. The company was founded on the promise of high-power, high-brightness blue laser technology for industrial applications. Traditional industrial lasers operate in the infrared spectrum. The key benefit of blue light is its ability to be absorbed far more efficiently by highly reflective materials like copper and aluminum. This is a big deal in the electric vehicle EV battery manufacturing space, which needs extremely precise and fast welding of copper components. The company's Numeron blue laser product line was supposed to be a game changer for welding, 3D printing, and metal processing in sectors like e-mobility, consumer electronics, and medical devices. The business model was simple: develop, manufacture, and sell these proprietary laser systems, along with related application development services. This is a capital-intensive business requiring extensive research and development. The old financial reports bear this out. While revenue was small, R&D and SG&A expenses were high, leading to significant net losses. The last few years of performance simply confirmed the difficulty of commercializing a highly specialized industrial product in a competitive market while maintaining a public listing. The financial reality of the laser business, with its deep negative operating income, is what forced the company's hand toward this transformation. It's a painful but clear illustration of the gap between advanced technological potential and the ability to execute on a scalable, profitable business model. The pivot, then, is a calculated risk. Instead of burning capital trying to scale up industrial laser sales, they are using their public listing and capital raise to acquire established defense tech revenue streams with higher potential margins. This pivot is the true current market driver, creating tension between the old, struggling fundamentals and the promise of new, high-growth, high-margin business models. The stock's jump in early October, a massive surge of over 140% in the prior month, was largely a reaction to these aggressive acquisition and corporate restructuring announcements, which is a powerful signal that the market is willing to bet on the new Nuburu even with its past baggage. The question is, can this highly leveraged strategic shift be executed effectively? The future outlook for Nuburu is entirely dependent on the successful execution of this transformation.